Facilitating our masterclass on accelerating the financial inclusion agenda is the Vice President, Economic Inclusion, Rockefeller Philanthropy Advisors with over 24 years' experience. She was formerly the Managing Director of ARM Financial Advisors, a subsidiary of the ARM Group, Group Head of Corporate Transformation, and the Executive responsible for IT at the ARM Group, where she initiated and ran a Tech Accelerator program. She currently serves on the Board of Advisors for ARM Digital Financial Services and Nana Digital Systems and is a member of the Women's Directors Development and Financial Services Committee of the Institute of Directors. Distinguished ladies and gentlemen, please welcome Henrietta Bankole-Olusina.
Thanks to the KPMG team and Boye for this invitation. Indeed, financial inclusion is really very, very important. And the crossroads of digital transformation, whether in financial services, fast-moving consumer goods, telecoms, or other tangential sectors, could help advance financial inclusion significantly if done in a coordinated and collaborative manner. And so this morning, my mission is really very simple: to talk about why financial inclusion is important, how industry sectors other than financial services can support it, and how collectively we can also drive for regulation that supports financial inclusion. So financial services, whether it's payments, savings, credit, insurance, pensions, or investment, are a cornerstone of development, certainly. And they help people escape poverty, whether by facilitating investments in health, education, as well as in their businesses. But evidence also shows that households and businesses that have access to financial services are better able to withstand financial shocks and emergencies, whether job losses or crop loss, than those that do not. And so, what does financial inclusion mean? Because I know that we use that term so very loosely, generally, and for some, it's a buzzword. Financial inclusion basically means that individuals, largely the poor and vulnerable that are often excluded, have access to useful and affordable financial products and services, with emphasis on the words useful and affordable. Because for those that are included, they are not as price sensitive. But the difference between being able to fund a transaction or not is really, really very high when it comes to cost of transactions for the poor and for the vulnerable. And so they need useful and affordable financial services and products that meet their needs, whether it's in payments, like I said, credit, loans, insurance, and so on. But it has to be delivered in a responsible and sustainable manner. So, in a real sense, you can have people who do not have access to financial services, but they do not have any financial independence, and they clearly are excluded economically as a result. So, for example, in Chile, we see clear examples where low-income women who were members of microfinance institutions and received free savings accounts were able to reduce their debt and had a higher ability to make ends meet when they had an emergency or financial shock. As you know, many people in that bracket typically they're one step away from poverty, whether it's health, whether it's loss of job, loss of crop, or whatever else. And a growing body of research actually reveals that many potential development benefits from financial inclusion exist, because from the use of digital financial services, whether it's mobile money services, payment cards, or whatever else, the poor and vulnerable are able to build out their lives. So we see that they're able to purchase more grain, they're able to invest in their businesses, they're able to invest in stock and inventory, and basically grow their economic viability. Now, the benefits from financial inclusion can be a broad range. And I think that where we find that in Kenya, for example, that access to mobile money services delivered big benefits to a group of women who they headed their households, And so they were able to increase their own savings by more than a fifth, and it allowed 185,000 women to leave farming to be able to open retail businesses and build out, again, their financial viability. It also helped to reduce extreme poverty among these women-headed households. Mobile money is something that hasn't taken off as much as it should in Nigeria. However, we believe that with digital financial services, as well as working with relevant players, financial inclusion is a key enabler to reduce extreme poverty and boost shared prosperity. So I put this up here just to bring to our consciousness, I'm sure we're all familiar with it, the 17 SDG goals. Believe it or not, 8 of these SDG goals are actually linked to financial inclusion. And the idea is that these can help us to improve lives and to create a more just and equitable world. So for example, SDG 1 on eradicating poverty, SDG 2 on ending hunger, achieving food security and promoting sustainable agriculture, SDG 5 on achieving gender equality and economic empowerment, SDG 8, economic growth and jobs, SDG 9 on industry, innovation and infrastructure, SDG 10 on reducing inequality, and 17 that basically strengthens that supports the strengthening of implementation and implementation partners, where there's an explicit role for greater financial inclusion through greater savings mobilization and consumption for sustainable growth. But traditionally, we have measured financial inclusion by account ownership. But the danger in that is we can go on and create accounts, open accounts for people that are excluded, but the real challenge is around economic viability. So account ownership is our traditional measure of financial inclusion, but in reality, it's really just an entry point. Yes, account ownership is needed to gain access and use financial services, but ownership alone is not enough to drive development outcomes. Indeed, global account ownership has increased from 51% to 76% in between 2011 and 2021, 2021, 10 years, which represents a 50% increase in worldwide average over that decade. So although we have seen that growth in account ownership based on the different initiatives for different countries, whether high income economies or developing economies, indeed, we see a steep growth, especially amongst for the developing economies. The growth is steepest for developing economies. But to the other chart to the right, you will see that the growth is not as steep as it should, as it's shown in terms of account ownership. So the chart on the right is actually account usage, savings. So the question is really, why have we not seen a corresponding growth in terms of the steep growth in usage, especially for developing economies, where clearly we have challenges around lack of digital ID, lack of access to financial services points, financial literacy, economic viability, to mention a few. Interesting thing is that an experimental study to test the impact of expanding access to basic bank accounts in Chile, Malawi, and Uganda found that giving free bank accounts, for example, to previously unbanked adults had no impact at all on savings or welfare, no impact at all. This finding suggests, therefore, that efforts directed only at expanding access to financial accounts are unlikely to lead to any real development or growth unless we have policies in place, we have products and services and incentives that are fit for purpose for the different developing economies across Africa to increase the use of accounts, whether it's for payments, for savings, for investments, for credit, and so on. Similarly, you know, we see it all the time where we have those account opening drives in Nigeria. And within a matter of 3 to 6 months, many of those accounts become dormant. Again, because of the lack of economic viability behind behind that drive. And so usage is absolutely critical. So the solutions that we need to be looking to accelerate financial inclusion need to address the barriers simultaneously, the barriers that we see. Digital financial services can help us to accelerate financial inclusion. As we saw during COVID-19, we had very many lessons from the lockdown, and we indeed saw growth across emerging economies, including Nigeria, from an economic perspective, helping us to accelerate the use of payments as well as the use of digital capabilities in driving financial inclusion. In fact, you may be aware that many mobile money players supported governments in continuing to provide humanitarian assistance during that period, and they continue to do so, whether it's in government payments, in providing utilities as well as agricultural solutions as well. So really, in the real sense, digital financial services, if we look at it, whether from a traditional financial service provider standpoint or from a fintech innovation standpoint, it has a potential to help us to drive financial inclusion and can be a powerful driver if we allow or create the enabling environment that is required. So this chart basically just tells us the jump and the growth that we've seen in mobile money. So in 2020, we had over 1 billion accounts. By 2021, we had 1.35 billion accounts globally, which basically supports over 1 trillion transactions, $1 trillion worth of transactions, which is almost 2 million per minute in terms of transactions, and 24 hours a day, 7 days a week, 365 days a year. We've seen growth in agent networks, even though in Africa we know that we continue to have challenges with agent networks and that last mile, being able to provide access at the last mile with agencies. We've seen even growth of more than 10 times over the last 10 years. But more importantly, I think part of what is driving this growth is the push for interoperability and integration of services as well as digital transformation that is creating ecosystems that players can plug into to provide services that are fit for purpose and speaking to the specific needs of people at the bottom of the pyramid. Today, we have more than 100 million unbanked adults in sub-Saharan Africa that have no ID. So it remains a major challenge in Africa. We still have a gender gap in mobile access, but even though some countries have more women having mobile phones than men, countries such as South Africa, Zimbabwe, and Kenya as well. Opportunities clearly exist for us to expand financial inclusion through better access to formal identification or digital identification and mobile phones. According to McKinsey Global Institute research that was done a couple of years ago, adoption and use of DFS can actually increase GDP of all emerging economies by $13.7 trillion by 2025. And this can help to create 95 million more jobs, as well as raise overall productivity, investment, and reduce leakage in government. So clearly, there's a broader macroeconomic case for us to pursue financial inclusion through digital financial services. And so we need to think about what those barriers are and how we're going to overcome those barriers. And part of what we need to do, part of what we're doing at Rockefeller Philanthropy Advisors, is to advocate for regulatory frameworks that support innovative models and help us to drive digital financial services. And that is how we believe we can accelerate financial inclusion. That is our working theory of change. We're all agreed that technology can help and is an enabler of digital financial service, undoubtedly. It can help. But despite the huge success in some countries in Africa, such as Kenya, when it comes to mobile money, we see many limitations as well. So for example, the sustainability of mobile money service being threatened by policies that, for example, talk about taxes on transactions, for example, as well as several other regulatory interventions, including a lack of instant and inclusive payment systems that can drive low-cost transactions. Again, the people at the bottom of the pyramid are extremely sensitive to price as well. But regulations such as open banking, such as agency network, building that out, is clearly an enabler of financial inclusion because it supports innovation. And innovation can help us develop products and services which are fit for purpose, especially for the poor and vulnerable. And you can then have innovators that are able to do things differently. So for example, Koyo in the UK, that is a thin file loan provider that is able to use alternative sources of information instead of standard documentary requirements to have a true and authentic view of the customer. So they use alternative credit models. You have open banking also supporting reduced cost of transactions, for example, and where you have players that are able to then provide credit without necessarily, without needing to factor in the price, of not knowing that customer completely, but they're able to fall back on other sources of data and reduce the cost of credit, but still maintaining the risk, without increasing lender risks at all. And it also gives us access to real-life data. Real-time data that helps us to understand the customer. I was listening earlier, and one of the people speaking was talking about, just understanding the customer and the data that we have. So having data powering faster, fairer, and more accurate decisions that are being made about people who don't have the history that you and I have from a financial services standpoint. We need to be able to advocate for those types of policies. We need to be able to advocate for changes to regulation that can hinder growth in digital financial services and help to have an enabling policy and environment so that we are able to see the type of leapfrog that we need to see when it comes to financial inclusion. So on the policy front, for example, being able to find the challenge with not having verifiable identity being one of the main reasons for exclusion, but looking to other climes, for example, India, where they have pioneered a successful model for universal identity, paying due attention to safety and privacy as well. The interoperability of systems and availability of low-cost switch for financial transactions are equally important. I think that when it then comes to looking at what we need the ecosystem to be doing, we believe that players need to be moving from operating in silos, operating as standalone businesses, and thinking more around ecosystem plays. And I'm sure Boye and his team have told you about all that earlier. So for KPMG and your clients, the focus should really be on supporting regulatory frameworks that enable shifting from traditional financial service models to much more innovative digital models that will enable platform businesses. That is important to us because we believe that when we have integrated businesses and an ecosystem that is built on partnerships, then we can begin to see real creative products and services. I hear people say all the time, oh, we have a women product. Oh, we have a women product. And I say to them, your women product is for the women in the city. Your women product is not for the women in the village or the women that are financially excluded, because we assume that the poor and vulnerable group are a homogeneous group, but in reality they are not. The difference between a woman in the northeast of Nigeria, say for example, and the northwest or the southeast who is financially excluded there's a lot of difference. There are socio-cultural norms, there are education and literacy levels, there are trust levels, there are different things that will enable them to actually use financial services. And so in advancing that financial inclusion agenda, I will say that we need to encourage our businesses to use better digital models that build out offerings that actually look at what the customers really need, what will be their propensity to utilize and be included within financial services, and as well as create other opportunities for them to improve their livelihoods, whether it's access to power, access to health, access to education, and job creation as well. I'll just stop there and see if we have any questions this morning. Thank you.
Thank you very much. I think that was well received. My question is around government policies. Because when you were speaking, you mentioned that financial inclusion does not stop at encouraging account openings for those who are financially excluded, but all the policies around government, particularly in third world countries where financial inclusion is big, has been towards that. So what are the initiatives or what are the sweeteners that government can put in place to encourage the usage parts that you spoke about? And what are the experiences you are seeing in other climes?
Thank you. So that's a great question in terms of how can government incentivize usage. I think that in terms of, first and foremost, having the right or a broad enough network that can provide access is one of the first key things. So we have, for example, just last week, a framework for women agency banking was launched just last week. And one of the objectives of that framework is actually to try to tackle the sociocultural challenge of rural women wanting to be serviced or to be served by fellow women. And part of that incentive, or part of that program will also is meant to incentivize women in the rural areas to then open retail businesses. Because if we're trying to get women agents at the last mile, we are then trying to, there are loans available to these women to purchase their POSs, start off their businesses, and then start to serve other women. So that's a clear example of how you can actually incentivize access. Now, usage is a different matter. In terms of usage, it is down to economic viability. But to this specific example I just gave, where the women are being encouraged to set up businesses themselves and they will become service providers to their locality or in their local community, there's an economic incentive for them. They then bring their neighbors, their family members, who are also then signing on, and we're increasing the financially included number. Beyond that, there are several other examples. So you find that women are being then put together into women economic empowerment groups, and there are several of those programs. We are involved with some of that work in Kaduna State, where we're creating women economic empowerment groups working with the Kaduna State Social Investment Office. And the women are being put in groups, they're being trained, because financial literacy remains a challenge. They're being trained, but more importantly, with that training comes their ability to use what they're learning almost immediately. So it's in lifestyle. People that are interested in fishing, for example, or trading, or in tailoring, they're all in those economic groups, and they're learning together, they're being trained, they're reusing that knowledge almost immediately, and they're building businesses in the process, as well as improving their economic viability. I hope that answers your question. Thank you.